Hey guys, in this video, we're going to talk about position management. Now, we talked about different strategies that we can utilize, and we talked about managing those and in what environment we would like to use those strategies. But we didn't really dive in deep into the actual management of those strategies. So today, what I want to do is I kind of want to just briefly go over rolling an option. All right. So we're going to talk about rolling options up, down, and in and out. So it all sounds kind of confusing, but really it's actually very simple and basic once you kind of realize and understand why you do it and when to do it and what you're actually doing when you do roll an option. So today we have a short strangle here wrapped around basically 30 delta on our June weeklies. Obviously, it's not a trade we actually do. Max profit's only $97. We would never we would never do this in a weekly cycle. But anyway, we have a short strangle on here. Tilray is currently trading right around $19, about 18.92. And let's just say we have this strangle on, and then Tilray starts to creep up. Now, as Tilray creeps up, obviously our deltas are going to change. So this 30 delta would no longer be a 30 delta. It would start going down. It would end up being a 10, a 5, etc. And this option contract here, the $17 strike, would start expiring, or it would be worth less than what it currently is now at a 30 delta. And the same over here with the call side, only it would be the opposite. So this delta would actually get higher because the stock price is creeping higher, right? So stock price creeps higher. You have more speculation that this 21 and a half will end up and expire at the money by this certain expiration date. And your premium would increase. So what happens in there is that Tilray would all of a sudden be up here around $20, say, you know what I mean, somewhere around here, 20, 21, 19, whatever. Our delta here on the 21 and a half would increase. So we'd actually be losing money here, but we would make up a little bit of money here because this short option would be worth less than what we originally sold it for. So what we can do is that we can actually roll up this option. And what we'll be doing is we'd be rolling up for a credit as well. So what you do when you roll is basically all you're doing is you buy back this option. So you buy back this option here. So let's say we sold it for 28. It's say it's worth 15 at the time when Tilray moves up. We buy it back for 15. And then all we do is just go ahead and then sell another option at the 18. Because remember, Tilray is no longer trading here; it's trading up here. So we sell at the 18, and then we collect the premium. That is the difference in between where we sold that original or where we bought that short leg back and where we sold here. Okay. So we would actually collect a premium on that. So if we're buying this back at 15, obviously we made, let's just say $13 on this, but then we're going to go ahead and we're going to sell this option here for around 70 cents. Well, now we're going to collect an extra 50 cents or so on our overall position in here. And all we did is just roll this up to the delta that we would prefer. So that's all that is. That kind of sounds confusing, but really all you're doing is just closing out this position here. So you have a short leg here on your puts, you buy that back, and then you just sell the 18. It gets confusing because you can do it all within a couple clicks of a button, you know what I mean? So all you have to do is just kind of open up your brokerage, click roll, and then it opens up the options chain, and then you can do it all at once rather than, okay, I'm going to buy this back. All right. And now I open up my chain again, and then I roll it. It's still the same process. It's not one big thing. It's still, you know what I mean? You're still closing this position and then opening that one. It's just they kind of do it all at one time for you and kind of make it easier for you on your brokerage. So that's why it seems like it is more complicated than what it actually is. And when we talked about rolling up, down, and in and out, what we did right here by moving this from the 17 to the 18 is that we actually rolled this up. So you're talking about rolling puts up. You're just rolling it up because the stock price is increasing, right? So you're going to roll this put up. You're going to roll it closer. This out of the money put, you're rolling it closer to where the stock price is. Now we're rolling something down. Obviously, we would roll these puts down, or we would do the ladder over here on the call side. Let's say Tilray starts pulling back. We're going back and we're trading right around 17 and a half. Well, guess what? There's not really that much extrinsic value in this call to really be had anymore. We sold it at 72. We can buy it back at 10 cents, because why are we going to hold a 10-cent contract for, or 10-cent options contract for? Who cares if we collect an extra $10? We can buy that back, roll this down here, roll it down to the 20s, collect, 20, 30 more cents by reestablishing and rolling this position down. So that's just when you say roll up or down, that's all that means. Now, when we talk about rolling out, what we mean is that we would actually go out to the next expiration date. So if we were going to keep this short leg on for our puts, and we wanted to roll this 20 out, or let's just say, where were we at? The 21 and a half. If we still liked where we were here and we just wanted to give ourselves some more time on the call side, instead of closing this position and then reestablishing within this cycle, all we'd be doing is we'd be opening up this next expiration cycle, and then we'd go out here and then we would reestablish at, let's just say we would do it at the 20. And then we would collect even more of a credit, because obviously premiums here next week out, they have more time, they have more extrinsic value. We can collect more by doing that. So that's all that means when you are rolling an option. And obviously you can roll long options as well. There's not really a whole lot of things that you would do that you would want to reestablish, because those are debits, right? So you're not really taking advantage of anything if you're rolling further out on a long, just plain old call debit. So let's just say we are in the 18s here, and we want to roll this out. Obviously, you would just you would sell this here, and then you would buy back another one. But really, it doesn't matter. You're just basically reestablishing in another expiration date. You're purchasing, it's costing you the same price anyway. You're not collecting anything special because it's just a debit. So that's the thing there. So anyway, that's when you talk about rolling. We talk about rolling in. Rolling in is if you're established in June 18th. Let's say we're short the 20 calls right here. If you want to roll in, you can obviously close that position, and then you want to reestablish it in the June 11th. So, if you say we're in the 20s on the 18th, then we just want to roll in and try to collect a little bit in the weeklies. Obviously, there's not a whole lot of times you would want to do that because you're trying to collect less premium. But it will come in handy every now and then if you would like to kind of roll in. But yeah, that's all it is. Basically, all you're doing is just closing out that one position leg, right? You're just closing it out. You originally sold this 17 put, you're buying it back, and then you're just selling it again, either up, down, or at a further expiration date. That's all that is. And you can do that all in a couple clicks on your brokerage, and it's called rolling. That's really all there is to it. Okay, guys, thanks for watching. Make sure to check us out on social media. We have attached the links to our socials in the description, and we also have a swing trading service if you're interested. There's more information in the description below.